Morgan Stanley says that your portfolio could fall 10 or 20% more in the coming weeks and months. Why? Are they right? Are they wrong? That's what I want to explain to you. I'm going to show you the basis of that announcement and the logic and the theory and the economics behind it. And I hope it'll make you smarter. I hope you understand better what kind of moves to make in the coming weeks. None of the following is financial advice. You know that by now. And let me show you what it is. This is the beast that is haunting markets at the moment. And what is it saying? What is it all about? But let me explain it to you, and then I go kind of a little bit deeper here. So on this axis here, we've got forward PE. So what's the price over profit ratio in a year's time? And down here, we've got the US Treasury yield, 10-year US Treasury yield. So right now, say the green one is the NASDAQ. We're right here. And right now, the NASDAQ is valued at about 23 times next year's earnings. That's sort of the market expectation. So what are they saying? Well, they're saying, look, this is at the moment where the 10-year Treasury yields are at 3.3% roughly when they did this chart. If it goes up, say, 1 percentage point, what's going to happen? Say it goes up to 4.3%. Well, let me draw a little line in here for you. And then we can see what little green bit here it touches. I'll zoom in a little bit more for you. And if I then draw a straightish line, thanks to Microsoft's free whiteboard app here, where does it get us? Well, it gets us to about 21 or thereabouts. You get a little bit of a brighter pen. So at 21, what happens? Well, if you go from 23 to 21, you have lost 10% of valuations. That's where they're coming up with these numbers. They're not making these up. There is actually some logic behind it. Now, what if you went to, say, 5.3% 10-year Treasury yield? Well, you'd go down about 20%. Now, what's the logic behind this? Is this just some, goggle-eyed quant in a basement somewhere at Morgan Stanley who made this up, or is this actually true? Well, this is a screenshot from a lesson of mine from our financial freedom program. And we've been teaching this for ages. And essentially, the way we value companies, especially those who have most of their profits ahead of them. So I'm not talking AT&T, I'm talking Microsoft or a growth stock or something that is going to make a lot more money over the next 10 years than they have over the past 10 years. Well, Microsoft's debatable, but you know what I mean. So what have we got on this chart here? Well, we've got present value here. So present value is what it's worth right now. Now, if I give you $1 million today, you'd say, thank you, Felix. Thank you very much. Very kind of you. But what if I gave you $1 million in 10 years' time? Well, $1 million in 10 years' time in today's money isn't worth $1 million. It's worth a lot less because you've got to discount 10 years of inflation, 10 years of opportunity cost. You could have invested the money, it could have grown. So you're going to get a discounted back. And that's what we do when we evaluate stocks. And I'll give you a free template and free full-length lesson on how to do that and how you can put a number on each stock that you own. And we call them discounted cash flow models, or DCF for short. Now, I need a brighter pen, don't I? A little bit of a fatter and brighter pen so you can see this better. There we go. So what happens? Okay, say you are here at 3% interest rate and you go to 4% interest rate. What happens? Well, this is a mathematical model. This is actually a chart from an engineering program because it's always the same. It doesn't really matter what the purpose was that was made for. And let me draw the 4% line. And what do you see? Well, the first one is at about 0.75. And the second one is at about 0.7. So you're losing, about 9% or thereabouts in value. So the 1% interest rate increase, very equivalent to the 1% increase in the US 10-year Treasury yields, will lose you somewhere, 8, 9, 10%, something in that range. And that keeps happening. So what's therefore the problem? Well, the US 10-year Treasury yield has actually gone over 4% since this chart was produced. So it's now actually sitting somewhere here and therefore discounting our stocks further. So what is it saying to you? The more the Fed raises rates, the more we think interest rates are going to stay higher for longer, the more we're going to move in this direction, and the more growthy it is. So this is the NASDAQ. This is, essentially a QQQ. If you looked at an ARC portfolio, this would look a lot more extreme. This would be something more like that. It would be a lot steeper. Why? Because they haven't got any money yet. They're not making any money. So, you're looking at something that is just steeper and it's losing more money faster as interest rates keep going up. And that's why I've been saying since last year and a half, I'd say, growth stocks are the things that get hit the most when you go into these kind of recession cycles where you get higher interest rates and higher inflation. So that's what we got to watch out for. Therefore, the one thing you really want to be watching is the 10-year Treasury yield. That's telling you basically how much pain you have to endure. Does it eventually rebound back? I think that's very likely, but you need a long horizon. Now, if you want to understand more about this, there's a link here. I put it in the description as well, so you don't need to type it in. felixschwenz.org/neo_DCF. And you might have no interest whatsoever in the NEO stock. It really doesn't matter. But what it is, it's a half-an-hour lesson and lecture. It's a spreadsheet template which you can use to put a value on any stock using the discounted cash flow model, which is what all banking analysts, all investment banking analysts do. And I think it'll help you tremendously to understand what you own, why you own it, what it's worth, and what makes it move. So I'd really, really encourage you to download that, use these lull days in the market to actually learn something, become a smarter investor. That's what the whole community here is about. felixschwenz.org/neo-DCF. If you then want to really take your learning further and actually build an income stream and make some money out of your knowledge, then come and join the Master Options program. We teach you how to make consistent income from options trading. My portfolio is up about 97% or something like that since the beginning of the year. So felixschwenz.org/options, write down our coupon code Build Wealth there and come and join 2,700 students and make some money. Thank you very much for tuning in. If you enjoyed this slightly more kind of macroeconomics kind of a content, then let me know down below. Write, more charts, or say, Felix, you lost me at minute 3. I'd find both very, very useful to make sure that I generate and create the kind of content that you find most useful, most interesting. Thanks for watching.